Right now, the market is filled with uncertainty. Not long ago, Bitcoin was showing relative strength against the Nasdaq, but in recent weeks, green days have almost disappeared, and the market is increasingly moving in sync with the global economy. Drops in the stock market are immediately reflected in crypto. The key question now is simple: how much lower can Bitcoin go if the global situation does not change for the better? Make sure to subscribe to the channel, leave a like, and let's begin. Let's start with the most optimistic case. The theory is simple. The market has already done what it needed to do. The first argument is the weekly RSI. Recently, it dropped below 30. Historically, this has been the zone where Bitcoin formed major bottoms. In 2018, the bottom was set in this area, and within 6 months, Bitcoin rallied about 205%. In 2020, RSI also entered extreme oversold territory, and over the next 13 months, Bitcoin gained more than 1,300%. In 2022, RSI again moved into extreme oversold conditions. Yes, there was an external shock with FTX that pushed price lower afterward, but structurally, the signal was close to a reversal. Now we are back in that zone. This is not a guarantee, but it is historically a high-value area. In my Telegram channel, I gave a signal exactly when RSI entered oversold territory. From that point, we saw more than a 15% move at the peak. If you do not want to miss such signals, make sure to subscribe. The link will be in the description. The second point is the 200-week moving average. Price tested the 200-week EMA and approached the 200-week SMA. In previous cycles, these were areas where long-term buyers stepped in aggressively. The 58,000 to 60,000 range has already shown strong demand reaction. That is logical. Technical levels and the psychological barrier of the previous cycle converge there. The third argument is that demand structure in this cycle differs from the past. We now have spot ETFs. We have corporate balance sheets. We have governments holding Bitcoin as a reserve. These players have absorbed significant selling pressure from early holders. This is not 2018, when the market relied mostly on retail. There is now an institutional layer willing to buy dips. However, there is a paradox of so-called paper Bitcoin. Yes, ETFs buy. Yes, MicroStrategy and other major players accumulate and treat it as a reserve. But a full reversal still requires retail participation. If retail sees stabilization, institutions alone may not be enough to ignite a strong expansion. There is also an important nuance. Even if this is the bottom, it does not mean we must see a V-shaped recovery. Historically, bottoms are processes. After heavy damage, the market digests losses, fear, and redistributes positions. This can take weeks or even months. Oversold conditions define a zone, not timing. So scenario 1 is possible. We may indeed be forming a bottom. The question is whether it will be a fast reversal or prolonged consolidation before the next impulse. That leads to the next logical question. What if RSI is giving false comfort? What if the cycle structure implies one more move down before final stabilization? Now the more realistic middle case. Not a perfect bottom at 60,000, but not a crash either. The 50 to 55,000 zone. Why there? First, the previous cycle. The main volume in 2021 was not at the extreme 69,000 highs, but in the mid-50,000 range. That was a zone of heavy redistribution. Such areas often act as magnets. A return there is not weakness. It is structural testing. Second, the 2022 precedent. RSI showed oversold, the market bounced, many believed the bottom was in, and then price dropped another 10 to 20% before forming a true base. If a similar pattern repeats, a move to 52 to 55,000 would look like a technical completion of correction rather than the start of a bear market. There is also a constructive aspect. If we see a controlled move into that zone without panic liquidations and without macro deterioration, it could become an ideal medium-term reversal area. In that case, weekly RSI remains in a historically valuable zone. 200-week averages stay nearby, institutional buyers get better pricing, and leverage is fully flushed. The market becomes cleaner without overheated expectations and excess risk. Such structures often lead to more sustainable upside, not a V-shaped pump, but a stable base followed by gradual expansion. So 50 to 55,000 is not a bearish verdict. It could be the final redistribution phase before a new growth cycle. Now the hardest case, not the base scenario but possible, the 40K zone. For this to happen, an external stress factor is required. The market does not fall 30 to 40% simply because it looks nice on the chart. It needs a liquidity or systemic shock. Why 40,000? First, the 200-week SMA. In 2018, Bitcoin perfectly respected it as the final bottom. In 2022, price moved about 30% below it. If we apply a similar structure, a 20 to 30% drop below current local lows leads to roughly 38 to 42,000. Second, percentage corrections of past cycles were 70 to 80% from peak. Even a softer 65 to 70% correction from the current all-time high again points to roughly 35 to 40,000. This is not catastrophe. It is historical comparison. What would trigger it? Rapid acceleration in yields and tighter financial conditions, a sharp equity market crash, a liquidity crisis, major geopolitical escalation, or systemic failure of a large financial entity. Without such catalysts, the probability of 40,000 remains limited. At the moment, structure does not point to inevitability. Yes, geopolitical tensions increase uncertainty, and safe haven flows could strengthen traditional defensive assets while Bitcoin weakens. But this is a stress scenario, not the base case. The conclusion is simple. 60,000 represents potential bottom formation. 50 to 55,000 is the most logical structural extension. 40,000 requires systemic pressure. No one catches the perfect low. The real question is not whether you predict the bottom. The real question is whether you have a strategy if the market moves 10, 20, or even 30% against you. That is why I consistently advocate DCA. It creates a foundation and stability even in the worst-case scenario. Friends, thank you for watching. Like and subscribe, leave your comments, and remember, this is not financial advice, just my view of the market.